Hello, this is Brian Rezny, President of Rezny Wealth Management. We have a great show for you this morning, and of course, if you have any questions that you'd like me to answer on our TV or my radio show that also then plays following the show on Sundays, send those to Brian Rezny at ReznyWealth.com. You can also visit our website, ReznyWealth.com, download any of our free reports. Great information for you, the retiree or pre-retiree. If you want to attend one of our upcoming workshops and meet me personally, great time to learn a lot about investing and retirement planning. Again, all available at ReznyWealth.com. You know, it's interesting. We look at, of course, we're at the end of 2014. We're approaching 2015. We're getting a lot of questions from radio listeners and TV listeners alike about what do I expect in 2015? Is the economy still going to be good? Are interest rates going to stay low? What can I expect with bonds? What about equities? Are we headed for a correction? Because as many of you might know, we really haven't seen any major correction of over 20 or 30% for a number of years. Now remember, all asset categories have risk, not just the stock market, the bond market, gold, real estate. All assets will bounce around and hopefully making new highs. But remember, mild pullbacks in all asset categories often happen a dozen times a year. What do I mean by a mild pullback? 2 to 5% pullbacks in prices, whether it's on a stock or the equity market, the bond market, gold, real estate, oil. All assets will bounce around. Remember, that gives you the opportunity, what we call the pause that refreshes in order hopefully to bounce up to new high. The reason the equity markets have done well in 2014 and we feel have a great opportunity in 2015 is simple. Corporate earnings are growing. Corporate sales are growing. If earnings grow, equity prices often follow. We've got tame inflation in the U.S. We have low interest rates. I believe we have a great opportunity for a sustained bull market in the U.S. economy. GDP has been pretty darn good, and it's expected, of course, to grow as we get into 2015. Investments to avoid is one of the topics I wanted to talk about today. And I'll tell you, I've been doing this for 28 years. Too often, too many investors call my firm after they've made a bad decision, after they were sold an annuity or a non-traded REIT or some other garbage from Wall Street or the annuity salesperson or the local investment person at the bank. Before you're sold a commission-rich, expense-ridden investment by Mr. So-called advisor, make sure you do your homework. I'm going to tell you the top investments you need to avoid if you care about your money and if you care about your retirement. Annuities. Annuities are dangerous for your wealth and they're dangerous for your retirement. Variable annuities and equity hybrid annuities. Both are disasters waiting to happen. Both annuities, both of these types of annuities, and don't think your advisor is selling one that is any better. All broker-sold annuities are sold under suitability, meaning those firms don't have to legally work in your best interest or give you the best advice. That advisor is selling products their firms represent, manufacture, and they are required to sell. Those annuities come with steep commissions, which take away your return, and come with sky-high expenses that take away your return. The average variable annuity that my firm has reviewed over the last 28 years averages between 3.5% and 4.5% every year of an average internal expenses. That robs your return. Most of the investments inside these variable annuities are mediocre, again, robbing your return. If you look at these hybrid or equity index annuities, these are these salesmen that tout these commercials where you can possibly get free money bonuses or these 8% returns. You can't get free money. There is no free money. And there's no 8% returns. It's called 8% return of your money. It's called a bonus or a return of your money. And all that bonus or those so-called 8% returns all have expenses to them. Many of these equity index annuities also have annual expense ratios between 3 and 4% a year, again, robbing your return. Lousy investments, and they hold insane surrender penalties that hold your money hostage for years. So once you realize 2 or 3 years after buying an annuity, or should I say being sold an annuity, You can't get out because you could have a surrender penalty that still could go another 7, 10, or 15 years of 10 or 12% surrender percentage in order to get your own money. Highway robbery. Non-traded REITs, real estate investment trusts. Now, brokerage firms love selling these because they manufacture these or they have selling agreements to sell. I can tell you, I've seen very few non-traded real estate trusts actually work out well for the investor. Most of these non-traded REITs carry stiff upfront commissions and underwriting costs, often approaching 20%. That means 20% of your initial investment is stolen or taken away off the top to pay the Wall Street firm or the broker commissions and fees. Crazy. Did you know that there are publicly traded REITs without that hideous markup, and they're liquid, that you can buy in an ETF format? Your broker probably didn't tell you about that because he doesn't make much money on selling you an ETF. They make a lot of money selling non-traded REITs. Non-traded REITs also are not liquid, meaning when it goes south, you can't get your money out. It could take you 10 or 20 years before that REIT goes public or before they decide to liquidate that portfolio. So avoid annuities and avoid non-traded REITs in your portfolio. Alternative investments, hedge funds, and commodity funds. That's been the big buzzword with Wall Street the last decade. You need alternative investments in your portfolio, they tell you. It'll soothe out the bumps. Go check out how the average hedge fund or commodity fund has done for you, investor. Lousy at best. The expenses on these commodity or hedge funds, again, are often approaching 4, 5, 6% a year. Sky-high expenses rob your return. Your Wall Street firm and broker love these investments because it pays them lavish commissions and huge ongoing revenue streams. Those are not good for your retirement, nor are they good for your portfolio. Too many investors are sold investments that they don't understand because these are highly complex. Never buy an annuity, never buy a non-traded REIT, and never buy an alternative investment, a commodity fund or hedge fund. Ladled with expenses, usually lock-up periods to get your own money with substantial penalties. Nothing complex or expense-ridden ever belongs in your portfolio unless you're trying to make your advisor more money than yourself and their brokerage firm. Larry from Boca Raton, Florida. Are mortgage REITs the way to go for high income? Something like REM. REM is the iShares. This is a mortgage-backed REIT, essentially. This is what I would tell you, Larry. Mortgage-backed REITs essentially are not real estate holdings. They're actually the mortgages on the real estate. Most of these mortgage REITs are leveraged, meaning they borrow money, cheap money, they lever up the portfolio to give you these higher dividend streams, let's say. The problem with that is when interest rates eventually start going up, these things can collapse big. We saw that in 2000. So at the end of the day, any investment that's paying absorbently high dividend streams or income streams, things that are approaching 8 to 10%, should normally be suspect. Not every one, but most of them should be suspect in your eyes. What's happened to a lot of investors the last 3 or 4 or 5 years as interest rates have come down, you, the retiree, is starved for income. So what happens is your broker comes up with these alternative investments that they show you, or you get looped into buying something that pays a high dividend stream, not understanding that that dividend may be a return of capital or substantial risk. If I look at these mortgage REITs, if interest rates go up just 1%, you could easily see a mortgage REIT like REM drop 10, 15, or even 20% in value. So remember, anything that pays high interest or dividends and is tied to interest rates can go down substantially when interest rates go up. So what I would tell you is this: if you're looking at something like REM, if you wanted to dabble in it, maybe say 5% of your portfolio, fine. But realize interest rates are going to impact that investment and you could lose a whole bunch of money, substantially more loss of principal, and it's not going to make up the extra dividend or interest you're receiving on those mortgage-backed REITs. Ted from Miami, Florida. Is 30% in bonds too conservative at age 29? Ted, this is what I would say to you. Again, I don't know your risk profile, but just by you telling me that you're 29 years of age and I'm assuming you're not retired yet, you really want to grow that portfolio. Having almost any money in bonds at age 29, to me, is a huge mistake, unless you tell me you can't handle some short-term volatility. But even with bonds, you're going to get short-term volatility. At 29, you should be trying to maximize the growth of your portfolio. Look at U.S.-based equities and utilize ETFs or exchange-traded funds. They're cost-effective, they're transparent, and they don't carry the shenanigans of mutual funds or other products often sold by Wall Street. The other thing that I would suggest at your young age, I hope that you're investing in a Roth IRA every single year if you can. Roth IRAs, you put the money in, it grows tax-free and it comes out tax-free. If you can just put $5,000 a year into a Roth, and you do that for let's say the next 25 or 30 years before you retire, you're going to have a substantial nest egg. And the best part, when you take it out, it's all tax-free. Huge plus. Look at the Roth. Look for growth in your portfolio. I would reduce your bond exposure in a couple areas. Look at small, mid-cap, and large cap, primarily in the U.S. right now, but I would have a higher emphasis on small cap at your young age. Carrie in Miami, Florida. My wife and I were sold 4 different fixed equity index annuities with income riders and bonuses. The advisor who sold them to us says he wants to replace 2 of them with a better product his firm is offering in a real estate trust. What do you think? Carrie, run from that salesman. First off, your advisor is not an advisor at all. They're working under suitability. Under suitability, that advisor sold you a bag of goods. They sold you 4 different equity index annuities. These are the most toxic of the annuities. I believe they're actually even worse than variable annuities, which I would never recommend that a client buy on the broker sold commission structure. Expenses are sky high. Now, the person sold these to you a few years ago. Now they want to get rid of those annuities, some of those, and put you into what it sounds like a non-traded REIT. That's to line his pocket and not yours. First off, you should have never been sold the equity index annuities. They're dangerous to your wealth and retirement. Go to my website, download my groundbreaking report, Why Annuities Are Dangerous to Your Wealth and Retirement. It's a great read. It'll tell you more detail why the annuities you were sold are garbage. Number 2, do not buy a non-traded REIT. You're going to basically take money out of one commission product. You're going to pay a surrender to get the money out, which is ludicrous. And then you're going to put it into another product that has an insane surrender time frame also and takes usually a 20% haircut off the top. Your advisor is no more than a salesperson of the products his firm represents, and he is required to sell under suitability. If you want to know more about fiduciary and suitability, which is just sales, you can also download my groundbreaking report, Your #1 Investment and Retirement Risk, Fiduciary versus Suitability. Too many investors fall prey to slick sales speeches from the advisor. Those titles they often use are window dressing to mask the fact that they're really just selling product, and they legally don't have to work in your best interest, nor do they have to give you the best advice, and they can actually give you advice that is downright bad and harmful to your portfolio. Being sold 4 equity index annuities tells me is you were taken to the woodshed. You need to get a second opinion. You can always call our firm for a consultation. We don't sell annuities. We're a fee-only money manager providing exactly what you probably wanted, which is real money management and risk management in severe down markets. I'm going to take a short break. Please visit my website, reznywealth.com. You can sign up for any of our groundbreaking workshops that are coming up. You can also download any of our free reports or also sign up for a consultation with my firm. I'll be right back after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. And we're back. We're taking your questions, of course. You can send me an email question to brianrezny@reznywealth.com. You can also visit my website, reznywealth.com, and you can send me an email question through our site. Sign up for a consultation. Visit our various reports on how you can protect your retirement, how you can grow your retirement income, how to make sure that you're doing the right things with your money. Go to reznywealth.com. Glenn from Fort Myers, Florida. I've been holding some floating rate funds as an interest rate hedge, but you can guess how things have been going. What is your opinion? Floating rate bond funds is what you're talking about, Glenn. These are actually excellent, in my opinion, and we actually hold some floating rate bonds or securities in our managed accounts at Rezny Wealth Management currently. Of course, our positions could change at any time. I like floating rate securities. These are basically bonds. They're very short term in nature, typically 90-day paper, and I believe they are excellent, especially in a low interest rate environment, because they can still get a decent interest rate, but as rates move up, they don't have the downward principal push that a typical bond, a longer term or intermediate term bond or bond fund would have. So floating rate securities, again, these are a type of bonds, are totally appropriate in a low interest rate environment. As rates go up, your rate can correspondingly go up along with it, but the big key is you won't see the massive decline in principal value when rates go up. Rule of thumb, if interest rates go up 1%, most floating rate securities probably won't change a lot in value. If interest rates go up 1% and you own, let's say, a bond mutual fund that owns an average 10-year maturity bonds or bonds inside of that fund, that portfolio could drop 10 or 12% in value just with 1% interest rate increase. So again, the longer the maturity, the more volatility or downside loss you could have in your portfolio. So as an investor, with rates being low, the economy is stable, there's a chance for rates ultimately to stay stable or slowly go up. I think investors need to really look at their bond portfolio, potentially sell bonds that they have now at potential big gains, look at reducing the maturity level, and floating rate securities fit that bill. Ken from Chicago, Illinois. Is Europe the place to be in 2015? What are your recommendations? Ken, I've had a lot of questions about Europe over the last couple months. You know, Europe's in a recession. Europe, statistically speaking, has done horrible on an investment basis the last decade. In fact, it's probably one of the lower areas for return on the equity exposure. I think Europe probably will come out of the recession slightly in 2015. I'm not looking for any big growth in GDP in Europe. Europe is extremely mature. Take the U.S., add another 100 or 200 years onto it, and a lot more political instability and the euro and all the mess going on. I don't think Europe's a great place to be. I think if you're looking to grow assets, I think a potentially better place to be is in the U.S. marketplace. And I do like the small cap on the U.S. I think it's underperformed in 2014. That gives you an opportunity, not a guarantee, but it gives you an opportunity probably for a bounce back in 2015. Remember, small caps about 80% of the time outperform large cap. In 2014, they actually underperformed. So what that tells me is there is a chance for outperformance. But what happens with most investors is they're going to re-add back to their portfolio what did best, which could be the one that slows down and comes back to where it should be. So look for outperformance in areas that have underperformed slightly. You may get better performance out of that. Europe, I don't like it. GDP's bad, recession, and geopolitical and the whole government issue over in Europe. I don't think it's a great opportunity for a long-term investor. Carrie and Todd from Fort Myers, Florida. We are concerned after hearing your show last week. Help. Our advisor suggested a security benefit life and Allianz annuity for our 401k rollover. He said we would get a bonus on deposit and 6% and 8% returns. Carrie and Todd, first off, the person that's trying to sell you an equity index annuity, whether it's those products or any product, is working under suitability. The person's a salesman. You need to read the fine print. What I would suggest you do is go to my website, reznywealth.com, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. It's groundbreaking. It's a simple report. Read it. After you read that report, you'll understand why you don't want to buy any annuity And specifically, you don't want to buy any equity index annuity. You have insane lockup periods. The expense ratio of these annuities are sky high. The returns are going to be dismal. To get all of your money out could take 10, 12, 14, 15 years, depending on the product. As for the bonus, there is no free money. That person is either outright lying to you about the bonus, or they're misleading you, or whatever you want to call it. But at the end of the day, there is no free money. If you get that bonus, most of these products charge you an annual expense ratio. Yes, to get that free money, they're going to charge you, let's say, 1% every year for the life of that contract. So you're actually paying to get free money. Not free anymore. As for 6 or 8% returns, not going to happen. The way these annuities are structured, equity index annuities in general, they have caps, limitations, and expenses. What I would tell you is this: from our detailed research at Rezny Wealth Management, if you really look at the hardcore numbers, if somebody bought an equity index annuity in general over the next 10 years, I believe you'll be lucky to make 2 to 3% a year if you're lucky. You'll probably be more between 1 and 2% net of all cost and fees. That bonus you're never going to see. And if they're talking about 8% withdrawal rates, that means you're taking your own money out, not actual return on your money. Avoid those. I'd also suggest call my firm for a consultation at reznywealth.com. Our number's at the bottom of the screen. We love helping investors who've been basically misled by Mr. Annuity Salesman. We'll show you what you need to do. We'll help you correct the situation. I always tell investors, there is a difference. Only hire a fee-only registered investment advisor, not a fee-based firm, not an annuity salesperson. Never pay a commission, and never buy a complex product with hidden costs, charges, and lacks liquidity. Sal from West Palm, Florida. My advisor has me in the Hatteras Alpha Hedge Strategy C, APHCX. For the last 3 years, it has done nothing. He tells me I should stay in. What are your thoughts? Sal, sell that. That's a mutual fund. Sell it. It's basically a mutual fund that basically is a hedge fund, and it has lousy, bad, disastrous, in my opinion, returns. And the expenses are sky high, close to approaching 4% every year. The reason, first off, the strategy to me is not working. You layer that with a whole bunch of expenses, you can understand in 3 years while you haven't made any money. Dump it. Your broker, which is really what he is, wants to keep you in because the trail commissions on these hedge funds sometimes can approach 1, 2, or 3% a year depending on the hedge fund or mutual fund you buy. So again, he wants you in because of the commissions he generates. Your concern, Sal, should be return on your money and return of your money. Sell it immediately. Find a real advisor. You can always call us. We do have an office right in Boca Raton, Florida. Joe from Davie, Florida. What are your thoughts about target date funds? Joe, I get a lot of questions on target date funds. All a target date fund is a mutual fund, okay? So if you take a mutual fund family that has, let's say, 20 different mutual funds, they basically start a new fund. They call it a target date fund, let's say 2025. And that means that based on your retirement in the years 2025, they're going to have a set allocation. They use all their own mutual funds. So they have some crummy mutual funds, they have some okay mutual funds, but they're all lumped in this target date fund, and they set a standard allocation. Target date funds, you don't want to be in. The expenses are high. You want to create your own. If you need an allocation, you create your own allocation using ETFs, low-cost ETFs, exchange-traded funds, not expensive mutual funds layered with additional cost of a target date fund. And ultimately, you can then buy the best of the best on the ETF platform versus being stuck in one mutual fund, target date fund, with all their funds that they're forcing in your portfolio. Larry from Naples, Florida. PIMCO Total Return Fund, what are your thoughts? I don't own it, and I would not buy it. The PIMCO Total Return Fund, of course, Bill Gross left a few months back. Just because he left isn't the reason why I would sell it. I would sell it, and I've told investors to sell this fund for years. It's just too big. When mutual funds get too big, you often see returns start to lag. What I would look at is look at ETFs, exchange-traded funds like I talked about earlier. You can build your own bond allocation or portfolio using a low-cost structure ETFs. And what I would suggest ultimately is, and I talked about this again earlier, be on the shorter term maturity, 2 years or less. If you own bonds in your portfolio, if you have bonds that are 5, 10, 15, 20 years, those are areas that you want to look at selling for potential gain. Remember, when rates come down, bond values go up. You can actually sell some of your bonds or potentially bond funds for capital gain. When rates reverse back up, you're going to lose that gain you have. So at this point, capital preservation in bonds, 2 years maturity or less, and there's great ETFs you can utilize to structure a portfolio in bonds. Fred from Naples, Florida. My advisor is suggesting I move my variable annuity to a hybrid annuity for income. I'm 68. What are your thoughts? Fred, again, your advisor is not an advisor. They're working under suitability. What he wants to do is get you out of one annuity and now roll you into do a 1035 into another commission-generating annuity for himself. Equity index annuities often have back-end surrenders that are often 10, 15, and 20 years in length. So you're 68. He's going to reload you in a whole new surrender penalty. That's ridiculous. Also, equity index annuities aren't going to give you higher income. You're actually going to get your own money back. If you do the math, and you look at these equity index annuities, or just about any annuity, but equity index annuities are actually worse, and you look at the income they're going to give you, do the calculation. What are they promising you? And divide that between how much you're investing. At your age 68, most of these equity index annuities will usually take you, as an investor, 20 years to get your own money back. Not a return on your money, your own money back. That's crazy. You deserve great financial advice and excellent service. Find out if you're on track. Schedule a consultation and portfolio review with my firm. You can understand and find out how to improve your portfolio growth, your retirement income, and reduce investment risk. Get answers to your important financial questions. If you're unhappy with the advice you're getting, if the advice you're getting is less than advice at all, visit my website, reznywealth.com. As I always tell investors, there is a difference. We invite you to experience it. Please visit our website, download any of our groundbreaking reports. Also check out our workshop tab. We have ongoing workshops around Florida so we can help educate you to make better investment decisions. I'll see you next week.